Good morning, traders and investors. My name is 𝗧𝗏 and I'm the senior strategist for �wealthPress. Today is finally October. It's October 1st. We made it through September, but October is the most volatile month of the year historically. But I'm going to tell you, if the last week of September is anything like October is going to be, then it's definitely going to be the biggest, most volatile time of the year. But I don't think that's going to happen. I think most of the momentum levels to the downside have been priced in, and I'm going to show you why. And remember, it's Friday, so we're going to review what happened during the week. I'm going to give you guys all the highlights and show you some things that happened. And questions that have been asked or answer questions that have been asked. So kind of give you guys a good summary of what's going on right now. First of all, markets are random right now, which is a good thing based on what we've been seeing pre-open. They're going to open up in about 2 hours. Nasdaq is up 3, the Dow's down 36, the nearby contract. I'm not really concerned about March. E-mini S&P's down. So this is very random, non-eventful. First thing we want to do is we want to look at the put-to-call ratio, which this week, boy, oh boy, look at this. Anything in this window is random. Anything above this window is beyond random. But this is bearish, very, very bearish, but bearish to a point of reversal, peak bearishness. Anything around, and I want to give you some perspective. So look at this over a period of weeks. Let's see here. There we go. Now this is right here where I'm pointing to. This is a year ago, all right, a year ago. Highest volatility we've had in a year. Let's go 2 years. Now we're talking. Look at this. We are at the highest volatility we had post the COVID. So unless the market's really going to crash right now, and I don't really see a reason for it to crash, and I've been talking about it all week, these are pretty extreme levels. I think we're going to go back up. And there's more signs that are pointing to that direction. Let me give you an example. So if you look at market momentum, if you recall, this is actually really important. If you recall, we had the large caps highly inflated compared to the smaller caps till this crash. Look at it now. Now you have only 23% of stocks in the S&P trading above the 50-day moving average, but in the small caps you have 42%. Same thing with Russell 2000. Look at Russell 1000, the large caps, 28%. Look at Russell 2000, 42%. Moreover, look at the Nasdaq 100. Remember the Nasdaq 100? All the market capitalization was in the Nasdaq 100. Look at the momentum levels now. We're at 18th percentile. We're at the lowest level we've been since COVID. So let me give you a perspective. This is 2 years. Let's go to 5 years. Look at where we're at right now. So could we crash from here? I mean, theoretically, let's see. Theoretically, we can, but I mean, where are we going to go? We're already at 18th percentile, right? So in my opinion, we are flirting with the bottom, and most of the momentum has been deflating out of these large caps already for quite some time. And that is and by the way, that's not it. I want to show you something else. Again, this is a show and tell. Look at the Dow. Look at the Dow Industrial. Yesterday, I think we had it up to like 10% or something. Let me look at this. We're near the bottom here. So yeah, we can go lower, but how much lower? It's not like we're right here in this market. It's crapping out. We're already down here, and we've been moving, and we've been going lower for a while. I've been talking about it since May of 2020. So this isn't just the start of something. So to me, this feels like the end of something, not the beginning of something, which is why I'm holding on to my long positions, even though they're down right now. Now, let's talk a little bit about the actual events of this week, the highlights. S&P ended September down 4.8%, the first monthly drop since January, and the biggest since March of 2020. COVID, March of 2020. Stock market has been unsettled in recent weeks with the spread of more contagious Delta, surging long-term bond yields, and word that the Fed may start unwinding its support program. That's really the crux of it right there. Japan's going to have a quarterly manufacturing report. The data came out actually better than expected, highest levels. That's really not what's impacting the market. I want to get to the meat and potatoes of all of this. All the sectors in the S&P ended up in the red. Technology stocks, banks, and a mix of companies provide consumers, goods, and services accounting for much of the pullback. More than 90% of the stocks fell in the index. That's kind of what I was just trying to show you. Now, Labor Department reported unemployment applications rose for third straight week. I don't know why I can't speak. Maybe because it's Friday. It's been a long, stressful week. But if you look at the numbers, they're actually not that bad. Let me show you here. We're still in the 300,000s. We're still, no one died. Nothing crazy happened. We've been going really, really low, and the number is 362,000. Not really a big deal. The moving average, 340,000. So it's going up just a little bit. But we went from like 800,000 to like 300,000 in pretty quickly between April and June. So or February and June. So again, I'm not putting too much emphasis into it. So the Commerce Department upgraded its estimate of economic growth. That's the biggest report of the quarter during the second quarter to 6.7%, which was actually slightly better than they expected. But it expects growth to slow to 5.5%. Again, I believe most of that is priced into the market. For example, look at the bond market. We're all the way down to the base. And yes, I do think the bond market's going to go lower, but not quite yet. I think most of the downside for now is priced in. We're already higher, and I think we're going to go back up to the resistance, to the support level over the next couple of weeks. I think this is too much too fast, and the bond market doesn't tend to react that fast. So I think we're going to go bounce up. I think the stock market's going to bounce up, at least based on what we're seeing on the indices, and I think we're going to go higher, actually. That's what the prognosis is for the week. Now, let me show you some interesting information. This is the Dow Jones. And if we look at the Dow Jones, as you can see here, we're very, very close to the 200-day moving average. And if you look at momentum levels, they are actually higher than they were a week or Monday, the beginning of the week, or last week. This was last week. So they're actually higher, right? Look, higher, but look at this is the Dow Jones Industrial, but look at momentum levels on the industrial. I want to show you this. Momentum levels. They're not going much lower. See, they're higher than they were last week, and I think the same thing is going to, where's that Dow? I think the same thing is going to go with the market. This reversal of momentum, as we could see here, I think we're going to start going higher. If anything, the 200-day moving average is here, and I do believe we've been pretty much flushed out. So again, takeaways for this week. I think the market has overreacted. I think we've seen too much downside. Most of our positions are negative right now for obvious reasons, but we took a profit of about 28% on this company, TEL, beginning of this week on Monday, and we have several positions that are open, and I believe they're going to start making money, and I'm opening new positions, and I'm opening positions to the long side because this market just looks way, way, way overdone. So my advice for you right now is don't make sudden moves, don't go making big decisions, lower your exposure, but everything is looking like a big shakeout, not like a beginning of a bear market. So again, that's my advice today. And if I were you, I would consider a position. I'm going to tell you right now what I would do. I would consider a position in the long bond because I think we're going to go all the way from the 144 level up to the 151 level, and then we're going to come back down. I think this red and purple channel is going to maintain itself for quite some time, at least till end of this month, beginning of next month. Why? Because earnings are coming out, and if earnings on tech is slightly better than what's expected right now, and I think most of the bottlenecks are priced in already, we should start seeing some upside. So I'm bullish on the bond market right now, and if you're an options trader, let me give you the options trader. Sorry, I'm a little bit all over the place, but I know it's Friday, and I want to give you guys the best update for the week ahead, and I kind of want to tell you what happened this week, and this is what's been going on. So if you're in a bond market right now, you may want to pick up the December 17th. Let's see here. Yeah, right here, 145 call. Right there. Now, I have no guarantees, but implied volatility is pretty low. We're already up 0.67 overnight. I think we're going to bounce off of this line. We may go down intraday, so you don't have to do it real quick, but I think at some point the bond market's going to start bouncing up. If we break below this, I don't think we're going to go down too much lower till we get more info from the Fed in terms of exactly what they're going to do. But I'm not buying this whole market is getting ready to break down. In my opinion, this was a big shakeout last week, and things are pointing to higher prices. Most of the members are concerned about if this is going to continue or pull back. And based on what I'm seeing right now, unless there's something grossly unforeseeable, like Delta really gets worse, I think things are going to get better instead of worse, at least for the short term. Now, folks, people are still trying to do their own research, but it's getting harder. It's getting harder to figure out this market with so many factors affecting price. I just showed you several. What if I said we could access a trading system based on a calendar effect that's statistically and economically significant, and it persists over time? Joy of the Head trader 𝗨𝗏𝗃 has embarked on a journey to change lives this year. That's right, I mean that. He wants to change your life this year. Handing over trading secrets he's never shared with anyone before. He's revealing how his legendary swarm strategy has produced over 46 double and triple digit winners. 46. There may never be another opportunity like this. Click on the link below and see how you can get access to what could be the most powerful strategy of the decade. Folks, 𝗨𝗏𝗃 is red hot. You got to check this out. This swarm strategy has produced 46 double and triple digit winners. Check it out now. It's Friday. Spend the weekend studying it, learning it. Follow what Jeff is doing. He's a hot trader, and he's up to something really, really interesting. And folks, make sure to like this video, subscribe to this channel. I want you guys to get all the goodies that's coming your way with this market. You're not going to get them ahead of anyone else unless you subscribe to these videos. So be the first one to get new updates from me. And again, I think the bond market's going higher, and I think next week we're going to undo some of the things that happened this week. Most of the momentum indicators are pointing higher. That's the biggest question everybody's asking. Have a great weekend, guys, and I'll see you on Monday.